Hello and welcome to our next panel on trade-based money laundering. I'd like to introduce our panelists first off. First up, we have Hermione, Regional Product AML Advisory Function at MUFG Bank. Hermione, I know, focuses on trade finance AML advisory, works closely with the first and second line of defense in the region to advise on matters relating to TBML. Prior to joining the second line, she spent a considerable amount of time in the first line as trade finance sales and advisory. Welcome, Hermione.
Thank you, Manesh.
Sure. Next, we have Kelvin, Head of Sanctions and Transaction Monitoring for HSBC Singapore. In his role, he oversees country compliance of HSBC's global sanctions policy, plus local sanctions regulations, and provides SME advice to support the business. Prior to joining HSBC, Kelvin headed group-level sanctions compliance at Singapore banks, with stints in AML-related work, as well as previously worked at the Monetary Authority of Singapore as well. Welcome, Kelvin.
Thanks, Manish, and hi, everyone. Pleasure to be here.
Hi. Finally, we have Nathanael, a partner at Rajah and Tann in Singapore. His practice encompasses shipping, commodities, trade finance matters, both contentious and non-contentious. He advises banks on these issues and has handled a number of commodity fraud investigations and cases. Welcome, Nathanael.
Hi, everyone. Good afternoon or good morning, depending on which part of the world you're in. Pleasure to be here.
Excellent. And we also have Grace, who will actually be moderating this panel. Everyone knows Grace as of Counsel at Simmons & Simmons, very experienced in this area, as well as in areas concerning banking, fintech, AML, crime compliance generally. So I'll sign off and I'll let you take over, Grace. Welcome.
Thanks very much, Manesh, and good to join everyone. Apologies, I had a little bit of technical issues earlier, and good to see everyone here. So to just kick off the session, I think we can start off by observing that think tank Global Financial Integrity has actually suggested that overall transnational crime could be worth US 2.2 trillion per year, much of which is facilitated by trade-based money laundering. So, Kelvin, perhaps we'll start off with you to set the scene for our discussion today. And can you briefly share with us your perspective of trade-based money laundering trends for the room today in APAC and some of the key challenges that institutions may face in addressing this risk?
Thanks, Grace. Personally, I found the GFI study quite interesting. Yeah, so for the uninitiated, basically what the study did, right, was they took the aggregate of exports and imports across countries. So, for example, if country A says that they export 5 billion of goods to country B, then likewise, country B's customs records of imports from country A should match. So is really looking at trade under and over invoicing at the macro, country by country and international level. So the conclusion was that if there is a mismatch, right, then it indicates that there may be movement of value that is disguised as international trade. So what I think the data and the estimates are not perfect. The message and conclusion is a sobering one, because if we talk about TBML, right, I think as early as 2006, the FATF has already identified it as a growing concern, and one of the three main methods that criminals use to move funds. So the three methods mainly are moving funds by the movement or smuggling of cash, through electronic transfers, and the third one is through the movement of goods. So the concern was that as governments and banks get better with the first two methods and build controls around those, criminals are increasingly turning to the third method, which is through goods to move funds and launder ill-gotten proceeds. And then we sort of go more than 10 years on, and we are still battling the risk and trying to get on top of things. And the estimates of the money laundered through trade has also increased. So from my perspective, I think for TBML risk is certainly very relevant for Asia, because we have the key manufacturing hub of the world in our region. And if we look at the top ports by container volume in Asia, right, out of the top 10 ports in the world, 9 are already from Asia, including Singapore, that's just behind Shanghai. So we do have a lot of trade and movement of goods that goes through Asia. And then by extension, if we talk about TBML as finding the needles in the haystack, right? By virtue of our volume of the haystack, we will expect to find more needles as well. So what is it about TBML that makes it so hard to tackle and reduce? I think in terms of the struggles and challenges, there are a few key ones to highlight. The first is, as I touched on earlier, just the sheer volume of international trade that takes place, especially for Asia, which makes it easier for criminals to then sneak in stuff amidst the very big volume. And this poses challenges not just to banks, but also customs to exercise due diligence. The second factor I would say is also on the part about information asymmetry. So the inherent nature of trade finance is such that the documents and the goods, they move in separate systems. So the banks do get limited visibility of the goods, and a lot of the manual documents, they are also issued and handled by various supply chain parties, which the banks may not be able to do adequate due diligence or have visibility on their legitimacy. And adding to that, each bank, as we know, will only get information on one small part of the overall transaction. The second part about information asymmetry is that in a lot of the banks, the people who actually know trade products well and undertake the transactional due diligence, they actually sit within the trade operations and middle office, whereas the information and understanding of the customer actually sits with the business. The other factor would be, I think, on the continued reliance on paper-based documents and instruments, which are more susceptible to manipulation as well as fraud. And the paper nature of this information also makes it difficult to conduct further analysis and automate controls. Last point I would like to highlight as a challenge we are facing today is most of the trade today is already done on open account terms, meaning to say that the banks actually get very limited information on the nature of the transaction beyond very basic payment details or summaries of transaction information in the case of supply chain financing without the underlying supporting documents. So how you then design controls and a risk-based approach to know when to ask for more information without stopping the bulk of legitimate business is then a key challenge to detecting TBML activity.
Yeah, so indeed, as you pointed out, Kelvin, I think information asymmetry, as well as complexity of the environment and the type of documents which banks have access to, means that it's a very challenging environment indeed. So, Nathanael, moving on to you, I think Kelvin has set the scene very well in sharing with us some of the complexity of the environment. So I thought perhaps you can bring us in on some of the action, because I know you have worked on some cases that involve trade-based money laundering. So can you share with us some of the recent developments and key points you've seen in some of the cases you have worked on, and how from some of these cases you have seen where is the landscape moving, basically? Yeah.
Okay. Thanks, Grace, and thanks, Kelvin, for that very detailed explanation or introduction. in addition to the three main points of TBML, which Kelvin has mentioned, I think the last 5 years, especially in Asia, we have seen really a fourth main category of TBML activity, which is sanctions compliance. And this comes on the heels of the UN Security Council resolutions, especially against North Korea, that were implemented, starting from September 2017, insofar as the North Korean oil and petroleum industry is concerned. So what we have seen as a firm, and I think we are seeing across the region with our overseas colleagues in our Southeast Asia offices, is that there is increased scrutiny, not only by regulators, but by financial institutions regarding sanctions compliance. And this really, in our experience, anecdotally, has taken up a significant portion of the TBML linked inquiries. Second, we like to see TBML focused work as pretty much a cat and mouse game. Pretty much the regulators and the FIs are the cats, and the criminals or the nefarious criminals are typically the mice. And it's always, in our experience, the case where the regulators and the banks, unfortunately, are playing catch up. And what has come to light, especially in the last 18 or 19 months or so, really beginning from the fourth quarter of 2019, is that we are seeing a lot of situations where big established names in the commodities market, superficially at least, may have appeared to have lent their names to some kind of activities where banks, in essence, have been hoodwinked into lending monies. Lending financing to medium or even large commodity traders to raise liquidity. And this really relates to the third category of TBML activity, which Kelvin mentioned, which is the movement of money where there are no underlying goods. So what we have seen in response to that is banks have reacted to that by, especially as Kelvin mentioned, for OA trades requiring more documentation. We now see, in addition from the usual invoice and LOI that is submitted for open account discounting, for example, we are seeing banks now requiring that notices of assignment be served and acknowledged to the bank itself. We are seeing more control by the bank in terms of the issuance of these notices of assignment. But certainly, from our perspective, more can be done. And when we say more, we do not intend to suggest that the bank should take upon themselves a role of a policeman in terms of reviewing every transaction that comes through its doors. Like Kelvin says, that would in effect have the effect of freezing the bulk of transactions. Ultimately, in our view, it comes down to KYC and training for the compliance officers. Is the information that's available to the front office also available to the middle office or the compliance team? Do they know the customer's trade flow? When they see the documents, often when documents are submitted for OA discounting, for example, all the bank sees is the unit price. Do you see the underlying import contract? In for example, oil sales, for example, most of the oil transactions are index price based. They are based off an index. In Singapore's case, let's say the mean of Platts Singapore pricing on a certain day or across the range of a certain day. We have seen instances where the indexes have been double loaded on top of each other. So instead of one index as the base price, there are cumulative indexes added up, meaning to say that the unit price of the commodity is actually doubled. So these will be red flags that the compliance team may not pick up without having seen more of the underlying documentation.
Yeah, so I think indeed, as you pointed out, some of this needs quite a lot of expertise of the staff, and I think especially in the area of oil, as you pointed out, you would need some experience on what are the key red flags, and in other areas, you do need to pay especially meticulous detail on this. So I think it's a good time to pass it on to Hermione, because indeed she would be the expert in really looking at in great detail some of the case studies on this. So Hermione, I understand that you have looked in, you're quite an expert on the FATF's case studies and guidance on TBML. And in terms of this, do you think that the FATF observations are really reflective of some of the practices you've seen, especially in Asia? And what do you think are some of the common red flags raised in Asia?
Yeah, thanks, Grace, and thanks, Kelvin and Nathan, for your for the introduction as well. So, I mean, whatever you mentioned, I think it's really what is happening, what we're observing in terms of the FATF. In March 2021, FATF actually released a set of TBML risk indicators. It's building on what they issued in 2006 and also building on what they issued in December 2021, which is the trends and developments of TBML. But I really like the this March 21st release. And if banks haven't taken a look at it, you probably should, because it's perhaps one of the most practical set of risk indicators that they've put together, and it's divided into structural. So they're divided into 4 pillars, and the structural is trade activities, commodity risk indicators, as well as the last one is account activity. So what it does, or what FATF is actually trying to say, is when you look at risk indicators in a trade transaction, for example, you need to look at it comprehensively. You need to look at the underlying party, so that's your structural risk indicators, right? You need to look at the trade activity itself, the trade flow behavior, right? So that's what Nathan was talking about as well. And third of all is you need to look at the documentation, right? So that's where you get your red flags. And it's not just simply as over-under invoicing or over-under shipment, right? It's really more complex than that if you look at the documentation. And finally, you look at the overall account activity of the client. So is it reflective of practices in Asia? I would say yes, probably so, but perhaps not really just for Asia, but really across the board. And I think the FATF risk indicator especially for the commodity risk indicators, I think a lot of banks, if you really look at it, I'm sure it would resonate with you, because you know it's in Asia, as what Kelvin's saying, we have a lot of key commodity trading hubs, right? And so we see a lot of commodity trade flows coming through Asia, and that's where, you know, for banks, because we deal with documents only, and when we don't look at, you know, we're not at a port, we're not at customs, right? We don't know if goods move, right? So the only thing we look at is documents, and that's where we get the bulk of our risk indicators, and of course how the client banks with us. That's where we see things. But I think in terms of common red flags, before we get into, you know, those common red flags, I would say that's really important for people to bear in mind that when we talk about a red flag, it doesn't immediately equal to a suspicious activity. I think this is quite important, and the FATF actually emphasizes that as well, right? A red flag or a risk indicator is just an indication or an activity that we observe. It's typically unusual, typically deviates from norm. It could be deviating from a norm of the client's behavior or deviating from commercial norm, for example. And it just says that it requires a review because it could potentially be suspicious. And therefore, when we review a case, I always recommend that we have to look at it holistically. One red flag doesn't mean that the entire transaction becomes suspicious, right? Because typically questionable transactions, when you look at it, there are always a couple of red flags that just seem to go hand in hand magically. It's like a combination. They will appear together, right? So couple of common red flags, I think the stuff that I personally would typically try to look at or focus when I'm looking at a trade transaction. First of all, something that is very common in Asia, related party transactions or intercompany transactions. It's, in Asia, especially for certain countries, transactions between intercompanies are extremely common, right? Well, it doesn't immediately equal to suspicious activity. It's a red flag or a risk indicator. I like to think of it as a risk indicator because it requires us to look at the legitimacy of that transaction, right? Because you want to make sure that there is a valid underlying commercial rationale for this related party transaction to occur. And I think the reason is because for related party transactions, from a financial crime risk perspective, there is there's an ease of collusion, right, between related parties, and thereby there's a higher risk or higher potency of a lot of other illicit activity that results from that, right? And so the front office needs to be educated on that, because if you talk to a front office, a lot of them will say, well, credit is okay with it, right? So in the mind of the front office, credit risk approval means the entire transaction is fine. But they've forgotten that credit risk is only one risk, right? You still have the financial crime risk to take care of. And therefore, we always recommend the front office that when you know you have a related party transaction, you really need to look at it to see whether there's a valid commercial rationale. That's one. Secondly, whether it's done at arm's length, right? So your pricing, is it at market price? Are the terms of the contract, set in the sense that it's like as if two unrelated parties are contracting with each other, right? The other one I like to look at is companies or even counterparties where they may exhibit shell company typologies, and I think we'll probably touch more on that later. But few things that always catch my attention when I look at trade transaction is when a counterparty is like a holding company, right? Or from the name, you can tell it's registered in one of those tax haven jurisdictions or jurisdictions with very weak financial crime controls, right? And they are, they don't look like they're in this commodity trade, for example, right? But the underlying transaction is a multi-million-dollar transaction, right? You also have a lot of companies where they don't have an online presence, right? I mean, interestingly enough, these small little things are actually in the FATF papers. So the FATF actually goes down to these details, and they might not mean anything. But when you look at a questionable counterparty, interestingly, you actually find that all these lists of indicators they just magically show up together. And that's why I say they go hand in hand. It's never just one thing that pops up. The last common thing I would say, especially in Asia, that we should look out for is missing trade documentation. So with what Nathan was saying earlier on, right, banks are asking for more, okay? Because they need more to evidence the real underlying trade transaction. Now, in Asia, the problem is there are a lot of countries where the regulators don't require, let's say, a transport evidence or a transport document to be submitted to a bank when they need financing, right? And therefore, a lot of banks would probably actually be financing transactions or processing transactions without evidencing any form of transport documents. And when you have countries where domestic trades are very high volume, okay, you don't have a transport evidence. So of course, for domestic trades, you're not looking for a bill of lading. You're probably looking for, let's say, at least a delivery note, right, or some form of cargo receipt, something that the bank can actually, help to do their checks. Now, these are not available because regulators don't require it, right? And there's always a misunderstanding or misconception within the first line that, we have a customs declaration. And we're always saying it's different, right? A customs declaration is, it's just, from customs perspective, all they're concerned with is, are you importing or exporting something that's restricted or strategic or dual use that needs a special license? And have you paid the requisite duties? But it doesn't mean that your goods have moved with the specific transaction that you're actually financing. It's not an, it's not an equal, it cannot be substituted for transfer documents. So I think these are the common, very practical things that may get overlooked at operations at the front line, which I think banks will probably need to pay more attention to, and just bring everyone up to that standards.
Yeah, thanks very much for outlining those. So I think indeed those are very important and helpful points, and you have indeed shed light on some very practical and very interesting insights. So Kelvin, I wanted to bring you back into this because I think you see a lot of what is happening on the ground as well. And I think Hermione actually brought up one very interesting point there on underlying documentation and the difficulties on a lot of on actually reviewing trades. And I understand that actually more than 80% of international trade is conducted on open account terms, and there's a lot of struggles on how much you can do to review a lot of these trades where you're struggling with missing documentation or non-existent documentation, or where you have gaps given what you have as a bank. I mean, there are initiatives right now discussing what the government can do, MAS can do to put something together between the different banks. But until that is put into place, that is what you have, I suppose, as an organization. So I'm keen to hear your perspective on how do you mitigate risk from open account trade financing or any other perspectives when you do have gaps in documentation.
Yeah, thanks, Grace. I think the very first basic thing when you think about dealing with open account transaction risk, right, is you need to first break down internal silos and then ensure there is sufficient cross-discipline type of training. Because to detect open account TBML, from experience, what we find is a lot of the times the initial triggers or entry point to investigations and to ask for further supporting documents, they actually come from financial crime controls that you build around payments, or even CDD type of controls, which are actually designed to catch other types of activities. So there's a need to maintain an adequate risk antenna to look at the risk across different risk taxonomies and consider whether you need to escalate further activity. Secondly, specific to open account TBML, I think you need to think about how such activity could look like in the transaction flows and from analysis of past cases that you have managed to detect. So questions to ask yourself would be: are there commonalities or opportunities to build controls to increase your chances of picking out the right transactions or right customers to drill further in terms of due diligence? So, for example, I think given the relevance of shell company risk to open counter trade, perhaps the controls can be focused on the shell company type of red flags. So, for example, is your customer suddenly transacting actively after being dormant for a long period of time, or has there been say an abnormal spikes in his activities? Is he trading in round amounts frequently, or is he trading with dissolved or bankrupt companies? And whether the goods, for example, are they aligned to the customer as well as the counterparties known business? Also, I think for TBML, one of the important things to keep in mind is there must be an element of collusion in most of the cases. So if you look at the open account transactions, I think one other aspect you can consider is, could you build controls focusing on uncovering hidden relationships or social link analysis type of due diligence? So, for example, is your customer trading with a related party, like what Hermione mentioned just now? We have risk with related company transactions. Is he transacting with an adverse counterparty that has been reported in the media previously, or an entity that maybe you have previously exited in another part of the business? And also, are you noting particularly high concentration combinations? For example, is this customer transacting unusually higher volumes with a particular counterparty and vice versa? Then maybe that's something you want to take a deeper look into. Last point I will add is I think the banks we also need to have a mindset shift. So from tackling TBML on a transaction by transaction reflect analysis style approach, which I think from the GFI study and all the data clearly has not been working too well. We need to perhaps look at risk from a customer lens. So we need to look at activities holistically across time and also across products. And we need to combine information, not just from the transactions and information available to the banks within ourselves, but also from public source information, as well as information on your counterparties that your customers are transacting with. And then we can apply analysis to help make sense of the activities and whether does it align with our understanding of the customer's profile. So to do that, I think first you need to set the policy and design the approach. And then in terms of how you can then execute this at scale without unduly compromising customer experience and increasing your cost, right? I think that is when you need to make use of technology and automation. But having said that, I think we need to also recognize that technology is not a silver bullet. And then AI and machine learning is not the solution to everything nowadays. So we need to really think of how we want to deploy the tech to achieve and what are we trying to achieve. And then we will deploy tech towards that means. It shouldn't be the tech coming before what we know how we want to tackle the risk.
Thanks very much, Kelvin. So, Nathanael, I'll be coming to you in a moment to ask about the legal challenges. But in the meanwhile, I see a very interesting question from the audience. So I thought I might bring this up with our bank specialists here, since we have two of them here. So the question is this: could you share how the bank does transaction checks to ensure trade transactions are in line with customer profiles? Also, is it done by the operations team or the compliance team? What kind of checks do they do, and is there an ideal model? So I think there are several questions broken down here, but perhaps you can split this between both of you, Hermione and Kelvin. But Hermione, we like to give some insights from your perspective. To start off with.
Yeah. Thanks, Grace. This is a very big question. There's a lot to.
Yeah, I know it's huge. So perhaps you can start the first two, and perhaps Kelvin the last two, so that it will be less of a hurdle, right? Yeah.
So first of all, before we even go into trade transaction checks, I think it's very in line with what Kelvin has been building up from his introduction to what he's mentioned earlier on. There is a need to, and this has to happen at the policy framework level, as what Kelvin was saying, right? You need to first of all have a discipline at the policy level where the customer, if a customer is being provided trade finance products, you need to build a due diligence on the customer, a special due diligence for trade. Some banks have been doing that, right? Because trade, as we all know, has a higher risk, is a high risk product, and it's prone to TBML. So once you have that due diligence set up, and that due diligence would be your customer's trade profile, right? And that trade profile would need to include, what is the trade flow of your customer? Do you know, right? Who are they going to import, export? What is the exact trade activity or precise trade behavior, right? That's going to happen, and downright to, for example, who do they transact with, right? So you basically have to look at their counterpart. First of all, the trade product. Second of all, in terms of trade activity, who are they transacting with, right? The countries, what is the underlying goods, the key, the key trading parties, for example, right? And from there, once you build that profile, then when the transaction checks happens at the operations level, so there's a question of, is it done by operations team? Now, let me put it this way: when you want to risk mitigate for TBML in a bank, right? It's not just an operations thing, right? Or it's not just a compliance thing. It is an end-to-end. There are 4 key players involved. It starts off with the front office, because the front office is the one bringing in the customer. You need to be responsible for building up that trade profile. And then it ends off with the operations, because that's the gatekeeper. That's the unit processing the transaction. That's where they are able to catch the unusual activity, but based on a good profile being built, right? And then, of course, you have the second line when there's an escalation, there's a red flag that cannot be cleared within the first line, right? Perhaps Kelvin can supplement.
Sure. I think in terms of the information you can check, right? There are vendors in the market out there today that can actually pull together information on your customer's counterparty from public source records, for example, from company registries. They can pull things like the contact information, the connected party of the company. They can do some simple social network analysis for you and then put together the results with some analysis in very quick fashion. In terms of the information on your own customer profile, right, then I think it's a matter of the institution itself setting up your structure to avoid silos. So there are some banks that choose to give the operations access to certain front office information, basic ones like at least the industry code, the nature of product, some most frequent transactions. There are those that choose to go through an RFI method, so to ask the RM and then to go through the due process from there. So differs across institution. It depends on how you set up your function as well. And I will agree with Hermione, there shouldn't be a division of problem. This is a ops problem. This is a compliance problem. Basically, it's the institution's risk that needs to be managed here.
Thanks very much, Kelvin. So it looks like we have just a little spot of time now. So moving back to you, yes. So moving back to you now, they always complain that lawyers were so pessimistic. So the last question to you, whether you could end off with an optimistic note for us. Even though there have been so much challenges for the TBML, handling of TBML investigations and challenges in this space, I was wondering whether you could share with us some advice or guidance on how on best practices which you have seen that FIs have been addressing this space on various practices and some overall guidance which you could share for FIs to end off this discussion.
Sure, thanks, Grace.
And if we have a bit of time, Hermione and Kelvin, please feel free to add. Yes. Yes.
Sure.
Go ahead.
From our perspective in Singapore, in terms of optimism, I remember when I first started practice, we had scenarios where banks were easily extending credit for trade products simply based on an Excel spreadsheet, what the customer did up. And I think that has moved on to banks at least require a copy of the underlying invoice or the LOI, and especially in the last 18 or 20 months or so, like I've said, more and more banks are requiring the customer agree that they themselves, the bank, serves the notice of assignment on the buyer and receiving a direct acknowledgement from the buyer. We also have seen banks annual risk review questions change. Like Kelvin has mentioned, we now see banks asking their clients, who are your top 5, who are your top 10 buyers, is there significant overlap between, your top 5 or top 10 buyers and sellers and vice versa. We are seeing a lot of banks coming to us to say, look, can we review our GTCs, our trade documentation? Does it, for example, give us the right to ask the customer for more documents in case of a compliance issue. In the event that the deal goes south or the customer becomes insolvent or we suspect some sort of fraud involved, is there a power of attorney that the customer gives us such that we can approach the counterparty directly and mount our own investigations? So these are improvements that we have seen in the market, I think, especially in the last 2 to 3 years or so, which suggests that banks are learning from past experience and from past case study. And the last point, to touch on what Kelvin mentioned earlier, which is the use of technology. I mean, much has been said about this, and we see in the market a lot of new startups, new firms coming into the market to say, I have this AI platform, I have this search term that can help you do that. But one experience which I would like to share is a couple of years ago, we were approached by an Asia-based regulator to say that they had obtained the tip-off that a transaction which they were which one of the financial institutions in their jurisdiction was financing, was running in breach of certain sanctions. And they asked us, we can't verify this. How do we do this? So when we looked at the underlying trade documentation which the customer had submitted to the bank, we found that the country of origin regulated the product in question very strictly. So much so that that country only had 2 licensed exporters. And we then went to the bank and said, look, you are a commodity finance bank. You would have financed transactions coming out from this country before. Why don't you pull out, for example, in the last 3 months, similar certificates said to be issued by this authority? And when they pulled it out, they realized that there were significant differences in the certificate which had been presented for this transaction and the previous transactions which were presumably bona fide. So I would have thought that if you had adopted some kind of AI software to correlate, for example, the font sizes or the font of those certificates with previous transactions, these would have been things that could have been picked up through automation rather than manually, like what we had to do in that case. So these are, so I would encourage banks to when they think about technology, not just to focus on things like KYC checks in terms of trade flows, in terms of counterparties, but in terms of the underlying documentation. If you know that a particular country requires certain types of documentation, what are the underlying source type data that you will look at to compare data points?
Mm-hmm. So thanks very much, Nathanael. So definitely, I think we're looking at things which are a bit unusual, not always on the FATF guidance, which Hermione pointed out, but definitely a little bit of care goes a very long way. So I think at this point, I see the flag coming up from the team. So definitely, I think it comes for the next session on the panel, which will be on human trafficking and supply chain risk. So we have definitely enjoyed this panel here today, and thanks very much all of you for joining me today, and I've really enjoyed moderating this panel, and hope you can stay on for the next panel if you are joining here today, and thanks for all of us for joining us today. Thank you.
Thank you. Thanks.
Thanks everyone, a pleasure.
Thank you.